debt allocation, on which modified duration for that portion is around 1 to 5 years. So on an average, you see where the modified duration is high also, the allocation is less. So the impact is not going to be more than 1% if 1% rate cut will happen in these funds. And obviously, it totally depends on client overall asset allocation basket, whether they want to play hybrid equity fund for their asset allocation part, or they just want to add depending on what liquidity they have. So on the fixed income side, if they have some liquidity, they should do. My sense, or like say what I believe is that they should look for GSEC fund at these levels. It makes much more sense vis-a-vis hybrid equity fund for the fixed income allocation.
Okay. Now, viewers, just to explain, sorry, maybe I overshot myself and I should have requested Kshitiz to add that, but we'll get Juzer to do it as well. Hybrid funds are essentially funds which have, as the name suggests, hybrid in nature, have a mixture of equity and debt. In certain cases, have arbitrage as well, where the relative components of equity and debt are not as much as, let's say, 65-35 or thereabouts. Target maturity funds are essentially debt funds, which have, as the name suggests, target maturity of the portfolio of the debt securities that they hold within the fund as well. Now, target maturity funds are subject to debt taxation. Hybrid funds are subject to equity taxation, as Kshitiz already explained. Juzer, I will go, and I'll go back to Kshitiz for the math as well. But let me first get in Juzer Gabajiwala as well to understand his perspective out here. And Juzer, your view could be different because the fund CEO that we spoke to, her view was different as well than what Kshitiz is saying. Now, I would love to understand if you believe that hybrid funds could provide a better alternative to target maturity funds from a perspective of somebody who's got enough portfolio size to choose the equity and debt components individually, or put it in a hybrid fund versus put the equity component separate and the debt component separate in a target maturity fund.
Yeah. So first of all, thanks for having me on the show. And so it's as actually even Kshitiz put it, that target maturity fund, if you want to play for interest rate, that's a different ball game by itself. Okay, so that basically requires a person to take a call on the interest rates, and I think most of the investors don't generally like to take an interest rate call. So having said that, I think if you look at it very simply, if you want to compare a hybrid with a target maturity, you cannot compare them ideally, for the simple reason you're comparing apples with oranges, right? But as you mentioned that, if a person has got an equity and he looks at debt and he can combine that as a combination and put it into hybrid, that definitely can be done. And depending upon what is the component of, equity he wants to have, now he's actually got a lot of choices, because even in hybrid funds, there are, you have dynamic asset allocation, you have aggressive hybrid where the allocation is nearly 65%, and you also have balanced fund where the allocation is around 50%, right? So in terms of taxation, if you go to see, what I look at is that supposing if somebody has got a 3-year time horizon, and if he even opts for a balanced fund, which is slightly conservative, okay, not the conservative hybrid because it attracts the full taxation rate. But if somebody goes for a balanced fund and or a dynamic asset allocation fund, which is debt oriented, and even if he takes the benefit of indexation over a period of 3 years, the taxation impact is hardly anything. So on equity oriented fund, you would pay a 10% tax, whereas over here you would pay a maybe 11% tax. Okay, so over a 3-year plus time period, the taxation of equity and debt more or less gets neutralized. I hope people will be able to understand, because taxation has now become a little bit complicated. So, and obviously that gives a better risk reward return, because if you target around, let us say, between anywhere 9 to 11%, depending upon what is the equity exposure and what time horizon you're looking at, you can get in hybrid funds somewhere a post-tax of around 8 to 9, 10%. Whereas a target maturity fund will give you, your post-tax will be 4.9 to 5.25. right? Now I'm assuming that the person is holding the fund to maturity. Okay, I'm not looking at somebody who's playing on the interest rates. If he plays on the interest rates, then as Kshitiz says, it would actually,
Juzer,
the will change.
right. No, Juzer, let me come to this then. So, okay, thanks for clarifying that for longer than 3 years, this taxation is 10 and 11%. I thought it was different. But let's assume that that's the case. What about something that Kshitiz mentioned, and I want to come to you. Leave the interest rate timing piece out. I'll get Kshitiz on that. But on a time horizon which is less than 15 months or less than 18 months, let's say, and therefore the taxation is well and truly defined and well and truly different for both categories, right? My simple question is that if I have, let's say, 30,000 rupees or 35,000 rupees in debt funds and 65,000 rupees in equity funds, and if I'm paying full taxation on that 35,000 rupees for a debt fund which I'm invested for less than 15 months or less than 18 months, is it better to therefore choose an adequate hybrid fund so that I have to pay an overall taxation of just the equity taxation as opposed to debt taxation that I pay for the 35% of the portfolio?
No, Neeraj, it would not. The math would not sit out there, because you are talking about then even investing in an equity fund with a 15-month time horizon. And we generally, when we advise investors, even if you want to look at any hybrid fund, you are talking with a 3-year time horizon. Now, with a 15-month time horizon, the target maturity fund, even if you take it as into an hybrid component, right, you may not get that return, because the equity markets, I mean, as it stands today, we have had a fantastic run up in the last year. Now, whether the same thing is going to go ahead down the line, nobody knows how the next year is going to pan out. So let us say, for example, today if I had to invest money into a hybrid fund, and I would say that, because I have that 35,000 which I can put into a target maturity and 55,000 into an equity fund. I hope I've understood your example correctly. Or I will put, maybe that a lakh into a hybrid fund and withdraw that money after 15 months. My returns could be completely different. So you cannot, like I said, these are two products which are actually an apple and an orange.
Okay.
So after 15 months, I would definitely not advise anybody to invest in a hybrid fund in any event.
Sure, but Kshitiz, okay, before we slip into a break, I'm forcing a scenario out here wherein somebody has only that period in mind. Let's say existing investments into debt and equity both, right? Now, two factors, Kshitiz, two questions rolled out differently. One is, if one doesn't want to play the interest rate call, as Juzer was saying, is it advisable therefore then to do a tax call here or no? Part one. And part two, please explain the math of somebody who's willing to go out and take that interest rate call. Because there are people of all kinds, right? There are people who come on the show, who send the queries and say, "Bhai, we believe rates are going to go down. Now tell us which are the funds to bet on."
Well said, Neeraj. Coming back to the first question, I think if you don't have much time on your side, then and you're at a peak of interest cycle, then I think you should take a call and look at playing an interest cycle, because normally we end up entering on the wrong side of the cycle. I'm saying we are very close to rate cuts around the corner, and we are very close to that. One should do that. Taxation wise, I agree with you, but when you have overall sum which is coming to 11-12% on your side on the fixed income, let's say gilt fund side, then still post tax you will end up making 8.5-9%. On the hybrid fund side, the only problem with less than 3 years is that you might get a benefit of rate cut on the fixed income portfolio, which is, as I said, will not be more than 1% of overall yield, because on an average modified duration of between 4 to 5%, and it's 20-25% in a portfolio. But you might end up losing some money on the equity side if market will not fare up well. So one should avoid doing that. So second part, when you said on the gilt side, or let's say on the fixed income side, I'll just explain and make it simple. This math's very simple. As I said, you have to pick and choose the journey. Let's say if you look at a gilt fund, you have 3 years horizon or 4 years horizon, but we are very close to, I think interest rate have peaked out. We are very close to rate cuts happening. So if you enter at this level and you have a YTM, which is yield to maturity, which is the actual coupon of a fund, which you will get normally if you hold it for the entire time frame. But let's say yearly coupon is 7.5% on an average across gilt fund. And you have duration which is around 4.5 to 5.5%, and you have a rate cut which is coming, let's say 1% in next 1 year's time. Now that entire portion of modified duration, which is 4.5, 5%, will get added because as yield, rate cuts happen, your bond price goes high. This is the inverse relation. That's how fixed income market works, and that benefit you get with the existing portfolio also. So it gets added immediately. So in a year's time, you can look at on an average anything which is in above double-digit return on a fixed income gilt fund portfolio. So I think there are 2-3 names which have done really well and where we are comfortable. But one should do their own due diligence. One is Bandhan gilt fund, SBI is there, Nippon is there, and I think this is a very important part of any allocation, asset allocation. Yeah. We can't just be sitting on. Earlier we used to say fill it, shut it, forget it. This can't be the scene now. You have to play a little actively. I'm not saying keep on churning the portfolio, but you can't miss on these opportunities which comes around you. So I think once you look at the gilt side of the portfolio, where you can easily make double-digit return from here onwards.
Got it. So viewers, 3 names out there from Kshitiz, and keep in mind, I think we've given you both sides of the argument. Depends on what kind of an investor you are. You can choose to play it the way either Kshitiz or Juzer mentioned. We need to slip into a very quick break. But on the other side of the break, we talk about one more very interesting topic on the mutual fund side. Stay tuned. Back with the Mutual Fund Show right here on NDTV Profit, in conversation with Kshitiz Mahajan and Juzer Gabajiwala. Gentlemen, I have 5 minutes on the show, so I'll be forced to talk about one topic. The one that I think will be relevant would be, how do people take advantage of this whole move that is happening in the real estate and allied sectors in the equity markets on the mutual fund side. Now, Juzer, have you guys done any analysis of which funds are heavy on the real estate side? And if somebody wants to take that call, that I believe that real estate will do well, and therefore I want to choose funds which will do well, then which are the funds to choose? What are your thoughts?
Yeah, so actually, I mean, what we saw is that, we had been also doing some thoughts on how the index has been behaving. And we saw that, the realities index has moved up by nearly 76%. in the last calendar year. And then we try to see that where are those stocks, anything which is available. But unfortunately, you hardly find much of exposure even in the thematic space. So you have this Housing Opportunities Fund as one of the plays which are there. But on an average, the exposure is somewhere around 7 to 8% of the entire corpus. So there is no specific thematic fund which is purely into the realty. But one way how a person can actually look at playing is could also be through the infrastructure space, because realty will basically require your steel and your cement, and it is a lot of more things than just real estate as an entity. So one way, and we have seen that infra also has started doing well, and so an infrastructure theme can be a better play than just a pure real estate play.
Are there a clutch of infra funds out there, Juzer? Do you guys like one over the other, or are there a series of 2 or 3 recommendations? It may not be an exhaustive list, but an indicative list.
So I mean, we are not able to give out recommendations as such.
Okay.
That maybe you can look at the ones which have been there in the market for last 3 to 5 years. Look at those existing players, and see which have got a consistent performance. But as it is, the stock cycle is a little bit less. So and only a little bit differentiation, because when Bandhan was IDFC and they had the infra fund, they were actually avoiding banking. So that was they were looking at a pure as an infra play over there. So that's the distinction which, if somebody wants to look at it, can just have a look at it again.
Got it. Okay. Kshitiz, come to you for the same question, really. It's a wide bucket. And I should have clarified. I don't mean only real estate, the listed names, but also real estate plus allied sectors. It could be pipe companies, cement, steel companies, whatever. How to best choose which funds will gain the most from this?
So Neeraj, I'll make it very simple. I think one can take a sectoral call, but in sectoral call, you need to come at the bottom of a cycle, and you need to exit at the top of a cycle, which never happens. So it becomes really little difficult for all the investors at their end also. Having said that, there are a couple of index funds from UTI and from Kotak, which are S&P BSE, housing index fund, where you can take exposure, where clear-cut realty sector has 23-24% exposure. And as said by Juzer, there are a lot of funds where Tata Housing Fund is there, HDFC Housing Fund is there. We have 12 to 14% exposure to realty sector. But as you said, your realty as a sector is a very vast sector which has many subsectors. It includes cement, tiles, pipes, FMEGs, a lot of other things which are there, which are related to this sector. I think best is to play through a flexi cap or a multi cap fund where you have a better exposure toward this side, rather than just playing it only through a sectoral fund. Because then you can run that fund, and depending on what sector is right now looking attractive, fund manager can change those sectors rather than just holding onto it. But for you, exiting and coming in will become very difficult, because then it becomes really difficult, because market is moving very fast, Neeraj, and sector rotation is very fast. So tomorrow some other thing was working, today some other thing is working. My suggestion here is that one should not look at a pure sectoral approach, whether through housing or infra, but rather than just look at a flexi cap or a multi cap fund or a focus fund where you have a better weightage toward housing or broadly reality oriented sectors. That's one should look at.
Okay.
And, yeah.
Point well taken. Now, unfortunately, we are completely out of time on this, but I commit to you viewers on the in the next 1 or 2 months, we'll get Kshitiz back to talk about these kind of funds as well, and do a very interesting conversation with Juzer as well on some of the research that they publish almost regularly. Juzer, it's been a while that we've discussed one of your research notes, so we should do that soon. But gentlemen, both of you, thank you for taking the time out and being with us today on the Mutual Fund Show. Really appreciate your time.
Thank you, Neeraj.
Thank you for having me.
The pleasure is ours. And viewers, thanks for tuning in to the MF Show. Stay tuned. Lots more coming up on NDTV Profit.